Cool. We are live, Shawn. We'll just give everybody an opportunity to get in here. So give me a sec. Okay, for those of you that are joining us now, feel free to place comments there. So we're right now, Shawn, we're live on LinkedIn as well as my Facebook business page.
Okay.
And so I was asking you, kind of cut you off when I hit the button to go live, but how's your day been so far?
Day's been good. I think in some sense, like everybody else, a lot of Zooms, a few join me's and other things that work to various degrees. But I think we're just trying to figure everything out. It's I think for all of us, it's been very much a day-by-day experience. And so, just kind of connecting with clients. Fortunately, people have been, I think because we're all in it, everyone's kind of trying to figure it out together. And so fortunately, there's been a little grace there. And so we've done some Zooms with phone calls, Zooms that didn't work and just a phone call, or, all sorts of things, but trying to move business forward.
Yeah, I think bandwidth, internet connectivity is being like torn up right now. It's been eaten up, like slow degradation and all that stuff. So, God bless us. We need it. We more than any time ever now to connect. So we'll go ahead and get started. And those that are not on, they'll be able to catch up. We can show a replay of this. But Shaun Smyth, CFA. And you're director of wealth management with Cope Corrales. And I thank you for taking the time out. We'll just go 20, 30 minutes or so, Shawn. Thank you for taking the time out. I was mentioning to someone earlier this week about, or last week, I should say, about what we're doing here. And I think there's so much information that's being put out there, like on the internet and, social media and text messages and stuff. And everybody's an expert at everything. And the biggest thing that, I'm seeing, like in regards to a gap, is how do we disseminate this information? How do we understand what's real and what is applicable? And so this is what you guys do. And I think it's very important. I got a phone call from a family member a couple weeks ago. They're about to retire. Mm-hmm. And he's saying, I think I should, I'm going to cash out of my 401k and I'm just going to take it all out. And I'm like, whoa. Like, don't panic. I don't think you should do that. I don't know what to tell you to do specifically, where to put the money, but I don't think that's a good idea. And so that's what led me to think about this here, because there's, I know I've been getting emails because I'm a client of Cope Corrales, getting emails from you guys, and you're doing a very good job at, keeping us informed and communicating to us about the market and such. And I thought it would be an ideal opportunity because outside of the mortgage industry, we have our own little problems going on with that as well. But it's important for our economy to thrive, for people to have the correct information and have a financial plan. So I'm going to be quiet. And what I'll do is, Shawn, if you could just tell us a bit about yourself, and then, we'll start to have more of a conversation.
Okay. Yeah, that'd be great. So, I kind of oversee sort of investment related activity for Cope Corrales. We're an independent registered investment advisor. So what that means is we provide financial consulting, investment, small business related advice to our clients. We have both individuals, a lot of dual income families, as well as small businesses and contractors around DC, Maryland, and Virginia. So we've been getting a lot of calls like that one that you have. A lot of folks, do I put everything in cash? Do I move forward? And we're really focusing on, there's two parts to it, right? So the relationships that we have with clients and that we try and build is, we try and grow that relationship over time and be communicating well and have a solid financial plan going in. I think Jamie Dimon said something pretty relevant. He said, in the middle of a crisis is not the time to figure out your plan, right? And ideally, and that's something that we've really stressed and worked with clients. And so I think, one thing to always think about when you're thinking about your financial advisor, whoever you're working with is, when were the last times we were talking? When were the last times we were connected? That's something that we pride ourselves on, is having those kind of conversations and building those relationships. So we had gone through and had conversations with most of our clients, in January, in early February, kind of check boxes, make sure risk allocations, make sure accounts were where they should be. And so those are really the types of relationships we have with clients. We also do a lot of small business consulting, helping kind of with alignment and restructuring of those businesses. And so we're located in the heart of downtown DC. And so all of this is, very personal for us. And, we're just trying to do our best for clients. I think the question about noise is a really good one. I think a lot of clients don't maybe fully, or a lot of folks don't fully understand what does news mean for the financial markets? What does headline news mean for financial accounts? No different than when I bring my car to the mechanic shop. I don't really know how he changes the oil, just that he does, right? And so, for people that are in our space, it can be a little confusing. It can be a little challenging. So for us, one of the things that we always want to keep in mind, and one of the things that we really encourage for folks to be doing. The financial markets are a forward-looking pricing tool, right? And so often by the time that we're hearing news, the markets have priced in a lot of that information. And so, for us, we try and look at forward indicators. In other words, what that means is if you take the S&P 500, for example, that's an index of the 500, a little over 500 of the largest stocks in the US. If you want to figure out what the value of that index is, you really take each company, you look at where it is today, figure out what its next year's future earnings are, and then you adjust that for some growth expectation, minus how much it costs them to run their business. You figure out the value of that company, you add up all the companies, you have the value of the index. And so, for clients that are saying, hey, look, I hear that the pandemic's getting worse. I hear that in a couple weeks we're going to peak. Do I do something? Do I sell out? Do I get rid of my stocks or my bonds? And the answer really is it does depend on a case-by-case basis. I certainly wouldn't sort of give a broad brush to everybody. But we need to understand that some of that bad news, some of those lost earnings, that's already priced in. We saw the market fall almost 34% in what amounted to 3 to 4 weeks, which is not the largest drop we've ever seen, but the speed with which it took place was incredible.
Right.
And so the real answer is once the losses have occurred in an account or for a client, often that's not the time to start making dramatic catch-up decisions. And so to maybe answer your friend or maybe answer a client if they were asking, we would really encourage two things. One is hopefully with your advisor, or if it was with us, we would have had a risk conversation going into this. In other words, do we have the right amount of risk in our account that we're comfortable with? Because we know that there's going to be these periodic times where account balances are going to go down. They happen at least every 10 years. It didn't happen this last 10, but we've quickly caught up to that in the 11th year. But the sort of general expectation is over the course of someone's life, there's going to be 10 or 15 recessions. And so the question is, the way to erode value is you take the losses, you get too nervous if it's too much, and then you sell what you have, right? And then so you basically locked in that loss. And so we look at it as a two-pronged approach. One is you need to have the right amount of risk in your accounts. You need to have the amount of risk that you're comfortable with, in stocks and bonds and whatever else you have. And if you have that going in, the ideal scenario is we stick to the plan. If we're adding to that account monthly, we keep doing it because we're basically buying securities at a discount, and that's going to really help in a period of recovery. The variable that we really toss in at the end is if, particularly in this case of the pandemic that we're seeing, if a client's job situation has changed, if income has changed, there's some exogenous or external variables that may cause us to have to reassess the plan. So at that point, what we'd want to do is sit down and say, okay, well, where are we today, right? We can't go back and change what we were entering in. From where we are today, what we know today in your situation, how can we best create a plan that gives us the best path of success, whether you have 2 years or 10 years or 20 years.
Okay. So speaking of pandemic, right?
Yeah.
What happened, Shawn? Like, how do we get here where we are with the financial markets? And, you mentioned, did you say 34%?
Yeah.
Like,
yeah.
What happened? How do we get here?
Yeah, it was fast. So I think this is going to be one of those periods in history that a lot of interesting books are written about. If 2008 financial crisis became a sort of what happens when individuals take as much leverage as companies, whether it's in the form of multiple homes or credit card debt or other debt, and we saw sort of a leverage deceleration in 2008. I think what we're really seeing here is, we're seeing unemployment numbers that we've never seen, and so I think a lot of content is going to be created about this small period of time. Without really going into sort of the pandemic itself, we are certainly by no means experts in the medical field. But largely what happened was, early February markets were still, in a fairly high point, close to all-time highs coming into this year. The economy was pretty strong. First quarter GDP expectations were in the threes. Unemployment was very low. Rates were still fairly accommodative, and there were a lot of signs that corporate balance sheets were strong. And then we saw somewhere around mid-February, really the market kind of woke up to, something going on in China. And at first, it was, and we've seen, while it's been fast, it's almost been in chunks. So that first portion, what took place was market participants and investors became concerned that there was a disruption in supply. In other words, if China wasn't producing the parts for iPhones or other components or the things that American consumers and global consumers wanted, companies might not have all of the product they need to be able to sell it, right? And so, say you adjust down forward earnings a little bit because there's a supply disruption. Even if you looked at the end of February, the markets kind of ended up a little bit. And then all of a sudden what happened in March is news came out and we really got a grasp of the measures China was taking in order to lock down and quarantine and prevent the spread of what was going on. And so suddenly it became, hey, wait, this is a supply disruption. This might be a few months. Companies like Microsoft said, we're largely okay till, call it the end of April, early May with current inventory. But once the world kind of saw how aggressive China was being in order to try and stop the spread of this thing, then people started to become imminently concerned. Like, wait a minute, this might not just be supply chains from China to U.S. companies being disrupted. This may actually be something that starts to materially impact companies in the economy. And from there, it was essentially kind of started to spread like wildfire. It popped up in Europe. Popped up in Italy and across these different places. It popped up in the U.S., first on the West Coast, and quickly was spreading. And that's really the heart of March, where we saw, -7 days, -10 days in the markets. Just really a 2-week, if you will, or so cratering of what's going on. And that was really a function of the market saying, okay, we thought it was a little bit of supply. Now we're concerned that there's no demand either. This is going to materially slow growth. This is materially going to slow production. So now we have a supply shock. We have a demand shock. We don't have products. We might not have people buying them. And that's kind of a double whammy. And that's when we really saw the negatives begin to spread. And then the sort of the final nail in the coffin as we hit the peak in late March was really, once the U.S. was sort of formally shutting down marketplaces, shutting down the economy. There were a few sectors that were kind of hit early on, some of the service sectors, restaurants and things, hotels, we saw it in some of the travel. But really we got to that place where, wait a minute, we're wholesale shutting down the economy. And then and we're still kind of in it. There's still some clarity lacking. This has never taken place in this context. And so then you saw just the final real bottom at that point, kind of March 23rd-ish timeframe, was really when saying, wait a minute, some of this stuff might not come back. We're not sure how long this is going to take place. And pretty much from the end of March through today, we kind of have seen this sort of up and down, we call it cautious, where we know it's bad. We sort of, the proverbial world's not going to end, but we don't really know what it looks like as this plays out. And so from a financial markets perspective, what you're seeing is the market's actually rallied almost 20% since the end of March.
Yeah, that was going to be my question is, we've seen these huge economic, and real quick too, there are people that are asking questions on LinkedIn. And please keep putting your questions in the comments, and I promise we'll get to them. I see a good college buddy of mine in there, and he's an analyst too as well. And so I think he's got a tough one for you, Shawn. So we'll get to that question in a bit. But like with the unemployment numbers that we've seen, it's my understanding that generally speaking, that should sort of negatively affect the markets. And so we saw, what was it, a 9% increase rather quickly. And so like, how did that happen? Like, what's driving this all?
Yeah, well, we saw a lot of the sectors that are sort of cash flow, certainly travel. People immediately, look at a company like Disney, fell almost 30% in a very short period of time. That travel kind of stopped immediately. Airlines, cruise travel, that whole kind of component of the market. But you also saw anything from restaurants to florists to small businesses really across the board. I believe it's something around the average small business in America has about 1 month of cash flow. And so, and we're a couple months into, we're approaching a couple months into this. And so, you had a lot of those sectors, hourly employees almost were immediately laid off in a lot of areas. So we saw, unemployment claims spike to 3 million, jump to 6 million, numbers that we had 2008 financial crisis was nowhere even in the magnitude of what we're seeing from pure unemployment numbers. Even large companies, the airlines, the hotels are furloughing employees. And so again, there's uncertainty around what that means as far as any potential comeback or rally in the markets, rally in the economy. The reason I think we've seen some increase, some sort of appreciation in stocks in the financial market is generally what happens is in the presence of uncertainty, the market prices in sort of draconian worst case scenarios, right? So that first $3.3 million employment number was terrible. It was as bad as we've ever seen. But in some sense, the market, depending on who you asked, was pricing in up to almost 4 million people. And so when you're uncertain, you can't really model that, and you tend to you sort of model what you think is worst case, and then you take another haircut off that. And so as bad as 3.3 was, it was at least a data point that provided some initial starting point clarity. And as bad as the 6 million number is, again, it's not great. There's no two ways around it, but we are starting to see some data, which doesn't necessarily help us predict anything. But what it does help us do is say, okay, there are some absolute bottom scenarios that are kind of off the table, and that starts to give this sort of foundation level. I would note that I believe it's every recession in the last 75 or 100 years, we've had roughly a 20% rally before testing market bottoms again. And so we're kind of around that 20%. Generally, the trajectory is, some new market low, some kind of 20-ish% rally, and then a drop back, and then a test back. The reality is, for any projections, there's GDP projections that are massive, up to down, a week ago, 2 weeks ago, you were hearing up to down 40% annualized. We don't sort of foresee that in the case, but I guess I say that to say the market's forward looking, and what's pricing in are some pretty atrocious numbers. And so if it's, minus 25%, minus whatever the number is, it's extremely bad. But it's also, in some sense, always going to be relative to what an expectation was. And so even if it's bad, if it's better than the worst expectation, it still could be a sort of a good purely from an investment perspective.
So are you saying the predictability in the data is what's helping to sort of drive this, to understand how to price the market?
Yeah, I wouldn't say that we're in an overly accurately predictive place right now. We've never seen sort of what's taken place. We've never seen the economy in this context shut down like it is. No, we don't really know. One is how long and how to the degree it will happen. But then what we also really don't know is how much of what's stopped is eroded, is gone, right? Where someone who had a business who closed that business, you can't just sort of start up and reopen a new business on day one of a recovery, right? There could be years before someone starts a new business, acquires a new space, and gets back into that, right? Even if if the quarantine is lifted, we all can't just run out and go to restaurants, right? I mean, they need to get some food, they need to get employees back, and there's going to be sort of a lag, and so there's a lot of questions out there around how quick does stuff come back online, and how much doesn't come back online.
And how big of an effect do consumer spending have on our economy? We actually talked about this a little bit, and I did more research. I didn't realize how big a number it was, but consumers, it's a big difference in the spending, right, for the U.S. economy.
Yeah, from a GDP perspective, it's well over half. And so it's one of the reasons that the U.S. economy through the years has been resilient in a lot of ways. We don't have some of the countries in Asia have much higher savings rates. Americans, for better or for worse, we like to spend, and money is sort of moving, and that drives a lot of the economy. Anytime you're moving out of a recession, generally, it's a very generalized process is, rates are lowering, money's easy, prices are low. And so you essentially the Fed and folks, you want to encourage people not to save and to go spend. And then the companies can ramp up production, people are spending, and the economy can kind of fire itself back up. And we've somewhat successfully kind of been able to do that. And so, that's a lot of the government measures, this $1 trillion here and $1 trillion there, and easing sort of lending standards, both in the US and abroad. Even the IMF is helping now to team up to make more dollars available. All of these things, they're meant to sort of put money into the economy. And the hope is that sooner rather than later, that money can get moving and consumption can kind of go back to where it is. I look at myself, it's hard. Like you can't really, a lot of the things that I normally spend money on, they're just not even available. Right. And so, remain a little hopeful that there's a subset of the economy, a subset of that consumption that can come back pretty quick. Whether it's someone who's just deferred a vacation, rather than, cancel their vacation. But unfortunately, the longer this goes, it's moving from some of the more hourly workers. It's moving into salaried workers, and it's impacting more and more people. And that's one of the remaining variables is just how long this occurs in its continued form. How quickly can these government programs get money to small businesses? But that being said, historically, consumption in the U.S. has been fairly sticky and fairly strong. And so we're hopeful that we've kind of broadly heard some good news on the medical side. We don't have necessarily any more information than anyone else, right? I mean, even the White House and the administration they're learning a lot as we go as well. And so from that perspective, there does seem to be a few data points that some of the acceleration has slowed. On an absolute level, we're still kind of going into the pandemic, but some of the acceleration is starting to slow in some areas, and that's a good thing, and we hope that continues. But there is a subset of the economy, I think, fortunately, there are people with technology today that are still able to work from home, and there's still some, I think, pent up consumer demand that'll come out. But there still remains a lot of questions around what sort of supply is going to be there, and how long does it take to get some of the services available that people would consume. And so, one analyst said, I expect in the next year to see both the worst GDP number of my lifetime and the best GDP number of my lifetime. And so, it's that question really is, and one of the greatest variables, whether it's, for the economy or also for individuals as far as their investments go, time is one of the greatest assets that you can have. And that kind of goes back to an appropriate level of risk in your accounts that if you can sort of bear what's going on, stay the course, maybe add a little if you have the opportunity, but really what you're trying to do is buy time. And what we know is that over time, over longer periods of time, economies grow, and there's real economic growth, and that's what we're trying to have our clients participate in their investments.
Okay. I have just a couple more things. So I want to get into the consumer side. So, for instance, I have clients, friends, family members that are watching this, other professionals that are in situation we just talked about. And then I want to talk about potentially the bond market specifically, and then we can wrap things up. But I mentioned I was speaking with several people, and a couple things, actually three things. Short-term risk mitigation strategy, right? Like, where am I today? How do I protect what I have? Like, how do I protect what I have today? And then also with the markets changing, there will potentially create some opportunities, right? To leverage what you've protected to create additional earnings or to have greater stability going forward. And then really also, what should we be looking at? So it's kind of a threefold question. I think you can answer it in one, but that's something that I'm finding the more I'm talking to people. These are the types of things that they're thinking about, including myself. Like, how do I protect what I have? And where are there opportunities in the future? And like I said, what should we be looking at?
Yeah, those are good. Again, I think the far as how do I protect or what do I do right now? I guess I would say two things. One is, candidly, now is not the time to sort of start thinking about how you protect things, right? If you're in a 60-40 portfolio, sort of the kind of stereotypical balanced portfolio, you're already down 15%. You're already kind of at that peak down of the year, right? And it's a conversation that can be had today, but it's ideally a conversation that you have entering in. As we looked at year-end changes and things last year, it was in the context of, hey, guys, we're 10 and a half years in to this run, right? And the risks are to the downside. Could there be another up 5 and up 10? Yes. But the probability sort of where we look short term was a little bit like, man, it would be pretty unbelievable to keep this thing running at the level it has been.
Right.
In a very quick period of time, if we stood here today, what we'd say is, can the market fall another 10 or 20%? It certainly could. But from a probability perspective, we're starting to get to that point as we look out 6 months or 12 months, the risks start to be to the upside. And I'm not sort of telling everyone to go out and buy stocks, but, it kind of goes back to that time question where if you're looking at something for 12 to 18 months, time is an asset. And now you can start to poke around as to what could I potentially buy from an opportunity perspective. From a risk mitigation today standpoint, the reality is that if someone hadn't done anything up until this moment, you've already sort of experienced a lot of the risks you'd ideally be looking to mitigate. If your financial position has changed, it might be an unfortunate time where you have to still kind of take some stocks off the table. The reality is that bonds right now, with rates basically have there's not much upside. They're more of a not as much downside type of investment. Treasuries are still a strong demand for the dollar. So there are some ways to kind of completely flatten volatility in the portfolio. But again, we would really encourage folks to talk to us, talk to your financial advisor, because you may have already experienced the worst of what you're potentially trying to protect from. And that's not really the point to get protected, right? If you sold a lot of stocks today, maybe it's another 5 or 10 or 15% that you didn't experience. But in all likelihood, if you look after 2008, a lot of that cash, a lot of that money, the market rallied 150% in 4 years after the 08, 09. And if you look at mutual fund and money market flows, a lot of investors, the Main Street investors, the mom and pops investors, didn't start putting money back in until 2011. right? And so you've missed that huge upside. So you locked in down whatever the number was, 20, down 25, and you missed that kind of first up 30, up 40, up 50, right? And that's a big number. And so if you can stay the course, would suggest that's a good place to be. But again, if something's changed in your financial situation and you need to sort of take some risk off the table, would sort of stay away from some of the higher yielding bonds in the bond market. There's the government securities there's strong demand for the dollar. Take some stocks off. There are some kind of minimum volatility type stocks. There are some of those sort of stable stalwarts that are not necessarily prevent you from losing money, but will prevent some of the wildly swinging volatility that we've seen. The old adage is that in recessions, people eat, drink, smoke, and end up going to need some health care. And so those consumer staples, healthcare, those have done okay on a relative basis. The riskier parts, the higher leverage parts of the market, like energy and tech, has sort of kind of swung fairly wildly. Had a pretty big rally yesterday. And so there are some types of stocks where you can stay invested, but maybe take some risk off the table. And that would, again, it'd be something you'd really want to talk to us or to your financial professional about. Just without knowing what you're in today, it's hard to say where exactly you should move.
Yeah.
Generally speaking, sort of selling out and going to cash at this point, not January, February, that's a potentially conversation to have. But generally, after you've experienced a large magnitude of loss, is not the time to get sort of overly aggressive and conservative. Aggressively conservative.
Got it. No, that's great. That was perfect. And I think it's going to help a lot of people. So I'm going to connect you with this guy, actually, Shawn. So I'm going to ask you this question, and then we'll end with this. But the question from my analyst friend, I think he's Fidelity. I'm not sure which organization or institution. But do you think the Fed stimulus is going to be able to at least stabilize the bond market? If you don't want to answer that, that's okay. But that's the question.
Yeah, no, it's a good question. I think the short answer is yes, and we've seen it. You've seen it in some spreads. Even high yield and the riskier part of the bond capital structure. You've seen spreads compress a little bit. One thing that we learned in 2008 is that while no one ever expected a bank to fail, kind of that end when the Fed really stepped in December 2008 and said, that's it, we're backstopping this everything. We learned that they mean it. And so, the bond market, the credit market, the government's done, the Fed has done a lot to stabilize those. I mean, they're taking all sorts of collateral as far as, pledging at the Fed windows. They're providing cash. They just announced a new program. I believe they're starting a whole new fund just to back the banks, so that the banks are willing to be a little more lend forward to small businesses. I believe JP Morgan's already made about $1 billion in small business loans. Mm-hmm. And so all that to say, that's not directly related to the bond market, but all that to say, there is both the means and the will for the government, the Fed and Treasury to backstop those assets. What that doesn't mean is that if someone goes out and finds the riskiest, widest spread, lowest rated bond they can find and it loses money, the Fed's not going to sort of make bad investments whole. But as far as a functioning market, whether or not it's good that the government's growing as large as it is in the context of the economy, I think that there's both the will and the ability to protect those markets and keep them functioning. And that's really what we've seen.
Awesome. Shawn, I appreciate this. This is great. Like I said, I've been telling people, guys, I still do mortgages. I do, but we've been doing these live streams because we want to find a way to, like I said, provide information and give value to the clients that we have and into our network. Because again, there's noise. There's so much information out there. And I'm going to continue to do the very best that I can to dig deep within our relationships and network to provide experts and put people in front of you to get a lot of these questions answered. So Shawn, how can we find Cope Corrales?
Yeah, I think for those of you that are for context that know you, I think the best place is really to connect through you.
Okay, definitely.
I can, yeah, I think that's probably the best place. I'm on LinkedIn as Shaun Smyth as well. Also copecorrales.com, COPECORRALES.com. All of our contact info is on the website as well.
Okay, and before we part ways with the audience here, do you have any parting words or?
I think the great thing about America and the great thing that we've seen in the context of American history is that there's a lot of there have been a lot of challenges, whether they've been wars, whether they've been sickness, whether they've been internal conflict. And each time there's been a lot of phenomenal innovation that's taken place. And there's been a lot of creators. It's one of the things that separates, I think, the U.S. economy is that sort of private sector innovation. And certainly things will go away, and that's going to be painful. But I think from an optimistic perspective, there's going to be a lot of good things that come out of this once we get through. The system will be better prepared. I think people have learned already. We've seen companies flip the script, within a week or two and have just a different business model to survive. And so I think we're going to see a lot of industries and a lot of sectors start to do things a little different, but in some ways maybe better. I think there's going to be a lot of innovation. I think companies are going to sort of start to figure out, okay, here's where we are. How do we learn? How do we grow? Where do we get complacent and what can we do better? So in that sense, not to make light of the challenges that we're still in. And I think there's going to still be challenges going forward. But I think Apple's delivering millions of face masks that they just developed and started producing, within the last week or two. There's tremendous innovation that can take place. And so excited from a purely financial markets perspective for, a couple of years down the road as we really start to see a lot of this innovation pop up and play out. And I think that, I think the American spirit will survive.
Awesome. I don't know how to follow that one up. I had a mic. I just dropped the mic for you. No, thanks a lot. Yeah, that's definitely relevant. And we've had to make some changes and pivot in our business as well. So yeah, I hear you loud and clear. So Shawn, thank you so much for your time today. Everyone that was watching, don't hesitate to reach out to me with additional questions. If you need a connection to Cope Corrales as well, I'd be happy to do that. But hope everyone stays safe. And stay at home. And if you have any questions, reach out. Thanks again, Shawn.
All right. Thank you.
All right.